Ladies and gentlemen, in just 24 hours, we're going to have a massive event in the market. The markets have celebrated that the new debt deal is done, but what this is going to cause is a flood of new treasuries hitting the market and cause a liquidity crisis. But I'm sure what you're wanting to know is, how exactly is that going to happen? How bad will it actually be? Will it just be a minor liquidity crisis, or could it lead to a much larger liquidity crisis? Well, everyone, that's exactly what we're going to cover in today's video. So let's not waste any time. Let's get straight into the news, the facts, and the data. Or some like to say, data. Look at this, everyone. $1 trillion treasury vacuum coming for Wall Street rally. Now, for those of you that don't know, a treasury is government debt. It's an IOU. Now, for example, there may be a 1 month treasury. So the government creates a treasury, you buy that treasury, which is a loan to the government, and they agree to pay you back interest. Say, for example, right now they're around 5% to 5.5%, and they'll pay you that back in 1 month, and they guarantee you get 100% of your principal back. So these are known as golden collateral and the safest assets you can get. But this new debt deal that was passed is going to create a new flood of treasuries hitting the market, causing interest rates to spike much higher. Bloomberg reports this will be yet another drain on dwindling liquidity as bank deposits are rated to pay for it, and Wall Street is warning that markets aren't ready. Now, it'd be very interesting to see if this scenario actually plays out, because if everyone thinks there's going to be a liquidity crisis and everyone prepares, maybe there won't be one, but we're all going to find out on Monday. The negative impacts could easily dwarf the after effects of previous standoffs over the debt limit. The Federal Reserve's program of quantitative tightening has already eroded bank reserves, while money managers have been hoarding cash in anticipation of a recession. So that's exactly right, everyone. The Federal Reserve has been doing quantitative tightening. We've been seeing bank reserves have been falling. We've been seeing other money supplies falling, deposits are falling, and this is going to be another blow for the banks that already have treasuries on their balance sheet, because, for example, they have a treasury that's paying 4% interest, but then they go ahead and issue a new treasury and that's paying 6% interest. A lot of investors are going to want to get the treasury that's paying 6%, and those old treasuries that are paying less interest are going to fall in value. And money managers have been hoarding cash because they say a recession is very, very likely at the end of this year. JP Morgan strategist estimates a flood of treasuries will compound the effects of quantitative tightening on stocks and bonds, knocking almost 5% off their combined performance this year. Now, for those of you that don't know what quantitative tightening is or quantitative easing, quantitative tightening is just simply tightening financial conditions, lifting interest rates, taking money out of the system. Quantitative easing is printing money, lowering interest rates, and making it easier and easier to get loans. So what they're saying here is the Federal Reserve's already doing quantitative tightening, but with more treasuries coming onto the market, that's going to lift interest rates as well. And that's probably why the Federal Reserve is skipping this June meeting, because they're very worried about what could happen with this liquidity crisis. Citigroup strategists offer similar calculus showing a median drop of 5.4% in the S&P 500 over 2 months could follow a liquidity drawdown of such magnitude and a 37 basis point jolt for high yield credit spreads. So in simple terms, what they're saying here, this is going to be very bad for stocks, because the treasuries are paying 6% guaranteed. Why would you risk putting your money in the stock market when you may only get a 1 or 2% higher return but take on much more risk? The risk to reward scenario simply wouldn't make sense. The sales are set to begin Monday, will rumble through every asset class as they claim an already shrinking supply of money. JP Morgan estimates a broader measure of liquidity will fall by 1.1 trillion from about 25 trillion at the start of 2023. So this is absolutely huge, everybody. The bond market and the treasury market, they control every single asset class around the world. If interest rates go up, then that means borrowing is much more expensive, and everybody uses debt to buy everything. They borrow to buy cars, homes, stocks, even cryptocurrencies, and yes, some people even borrow to buy bonds. And they're saying there's going to be a liquidity fall of 1.1 trillion. And for those of you that don't know, this kind of contraction is something you would see during a 2008 Lehman-like event. This is a very big liquidity strain. We have rarely seen something like that. It's only in severe crashes like Lehman crisis where you see something like that contraction. It's that trend, together with the Fed tightening, will push the matter of liquidity down an annual rate of 6% in contrast to annualized growth for most of the last decade. And we can see with this chart here, equities have suffered when bank reserves tumble. So S&P 500 returns have been negative following a 500 billion drawdown of bank reserves. This is what I've been trying to warn people about. All the fundamentals aren't making sense why the stock market is rallying, the only reason why it's rallying is off irrational exuberance. All the hype of AI, but once that hype dies and these 5 stocks that are holding up the S&P 500 fall, we're going to see the indices crumble. So with the default narrow averted, the Treasury will kick off a borrowing spree that by some Wall Street estimates could top 1 trillion by the end of the third quarter, starting with several Treasury bill auctions on Monday that total over 170 billion. Again, I don't know about you, but I'm very eager to see what happens at this auction on Monday and what kind of interest rate spikes we do see. What happens as the billions wind their way through the financial system isn't easy to predict. And again, I'm not saying it's going to happen for certainty. Even Bloomberg, all these economists can't predict with certainty, but it's definitely not looking good. There are various buyers for short-term Treasury bills, banks, money market funds, and wide swath for buyers loosely classified as non-banks. These include households, pension funds, and corporate treasuries. But who's going to be buying and who's going to be paying? They say banks have limited appetite for Treasury bills right now. That's because the yields on offer are unlikely to compete with what they can get on their own reserves. But even if banks sit out of the Treasury auctions, a shift out of deposits and into Treasuries by their clients would wreak havoc. Well, what kind of havoc could this cause, everyone? Citigroup modeled historical episodes where bank reserves fell by 500 billion in a span of 12 weeks to approximate what will happen over the following months. Let's find out. One scenario is that supply is swept up by money market funds. It's assumed that their purchases from their own cash pots would leave bank reserves intact. Historically, the most prominent buyers of treasuries, they've lately stepped back in favor of better yields on offer from the Federal Reserve's reverse repurchase agreement facility. Yes, the old reverse repo facility, everyone. We can see here that these money market funds are parking money here around $2 trillion per day, and they're getting paid 5% interest, taking no risk whatsoever. Don't you wish you could do that, everyone? But no, that's just only for the rich elite. That leaves everyone else, the non-banks. They'll turn up the weekly auctions, but not without a knock-on cost to banks. These buyers are expected to free up cash for their purchases by liquidating bank deposits, exacerbating a capital flight that's led to a cull of regional lenders and destabilize the financial system this year. So these non-banks could spark another liquidity crisis and a run on the bank's deposits. And you want more proof, everyone? We'll look at the US money supply is projected to decline further. A measure of liquidity tracking US money supply and money market assets is expected to decline by 1.1 trillion according to JP Morgan estimates. Whenever the money supply goes down, stocks follow soon after. But now relief about US avoiding default has deflected attention away from any looming liquidity aftershock. At the same time, investor excitement about the prospects for artificial intelligence has put the S&P 500 on the cusp of a bull market after 3 weeks of gains. Meanwhile, liquidity for individual stocks has been improving, bucking the broader trend. But everyone, if this analysis is right, this trend is about to reverse and about to reverse big. They say that hasn't quelled fears about what usually happens when there's a market downturn in bank reserves. Stocks fall and credit spreads widen, with riskier assets carrying the brunt of losses, aka all the hype AI stocks right now. It's not a good time to hold the S&P 500, says Citigroup Willer. We think there will be grinding lower in stocks and no volatility explosions because of liquidity drain. We have bad market internals, negative lending indicators, and a drop in liquidity, which is not supportive for the stock market. So everyone, I know what you're thinking, well, okay, what does all this finance jargon mean for you in simple terms? What this simply means is supply and demand. There's going to be more supply added for treasury bills. That's going to cause the interest rates in all debt classes to go up. This is going to cause bank reserves to fall, the money supply to fall, and normally when we look at history, this is followed by a market downturn. So I don't know about you, but I'm very excited to see how this plays out on Monday. And of course, what I'm doing, long-term investment strategy, diversifying to gold, silver, and Bitcoin. That way, if we do have a financial crisis, people will flood to safety with gold, and then silver tends to follow that. And hey, if there is a market melt up, Bitcoin is there. It also gives other tools, like if you need to get out of the country, you need to take money out of the country, $500,000, $1 million, you can go through the airport having your private key memorized, where it's very hard to do that with gold. And I've just launched a brand new course called The Golden Path to Wealth, Mastering the Trinity Portfolio. I've got 12 spots left. You can get it half price during the pre-launch before the course is completed. So everyone, what do you think about all of this? Let me know down below. Now, for my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.